How to become a millionaire in 20 years by investing. This is a step-by-step guide, the exact blueprint that I and many others are following to hit millionaire status, to hit at least 7 figures, if not multiple 7 figures. And I'm not a financial advisor, there is risk in investing, just want to get that out there, please don't sue me. But this is my personal story alongside my plan for a 7-figure future. If you know you want to start investing, you know you should be building, but you don't know where to start, this is the video for you. I built my portfolio to 100k mainly through my job, my business, my cash flow businesses, but I'm using this investment guide as a retirement plan. You know, I've been putting money away every month, I'm letting it compound and I'm not touching it for 20, 30, 40 years. You know, this is my hedge against the riskier, tumultuous journey of entrepreneurship. So if you want to get rich faster, increasing your income, your active income, or starting a cash flow business is the way, of course. But if you want to get rich slowly, if you want to almost guarantee the sort of rough time horizon with X number of years that you will be worth a set amount of money, then this guide is for you. So step 1, understand what it means to invest. Understand what you're putting your money into. So by definition, to invest is to put your money into a financial plan, shares, property, or a commercial venture with the expectation of a profit, with the expectation of a return. So you're putting your cash into a financial vehicle hoping that it moves. And so for this guide, you really want to be investing in ETFs or mutual funds, and don't get too bogged down with the terminology and the acronyms, but you want to be investing in a collection of assets, a basket of stocks or bonds under a single umbrella. So for example, if you put your money into the FTSE 100, for example, you're putting your money into the top 100 stocks in the UK. So instead of buying an individual stock, instead of buying, say, Apple or Tesla, you're basically buying a small bit of a few hundred different companies. And again, you want to generally avoid buying these single stocks, the Apples, the Teslas, especially as a beginner. Single stocks are typically more speculative, and besides, if you put all your eggs into one basket, if you put all your money into Tesla, and then Elon Musk decides to tweet something crazy on Twitter, your entire portfolio plummets in an instant. Whereas if you invest into a basket of stocks which contain Tesla as a smaller percentage, your portfolio is less affected by the actions of individual companies or CEOs. The single stocks are riskier, unpredictable, and uncertain. And you know, the goal of this guide is how can we guarantee a set amount of money in X years over a set time horizon? How can we hit this 1 million in 20 years? And I say guarantee for a lack of a better word. You're not guaranteeing this result. Don't sue me, I'm not a financial advisor. But how do we hit this 1 million in 20 years? To do this, we look at the baskets of stocks, the ETFs. ETFs are more reliable and steady than single stocks. You can almost predict or forecast the value of your money over a set time horizon. And so with these ETFs, you're buying a small slice of the entire stock market itself. The main advantage of ETFs, of these baskets, is that we have the historical data. We have the ability to predict future returns using historical averages. We can forecast and plan that if you invest a set amount every month on time in X number of years, you'll have roughly 50,000 or you'll have roughly 100,000, depending on your calculations. And so the ETF gold standard is the S&P 500, a basket of the 500 largest companies in the US, usually tracked by funds like VOO, SPY, IVV. When you buy the SP 500, you're buying the 500 biggest companies in America at once. You know, other popular baskets, other popular ETFs include VTI for the total US market, VT or QQQ for tech and growth, SEHD for dividends. You know, different tickers, different ETFs with the same general idea of aiming to diversify. And so you pay a very small fee, which is usually capped, a small capped fee, usually about 0.03 to 0.003% a year. So on 10k, that's roughly $3 to $30 annually. And you pay this fee because these baskets rebalance automatically. You know, winners grow, new leaders enter, losing companies shrink and get cycled out of the top 500. And that's why a basket like the S&P 500 stays relevant for decades. Your money is always concentrated in the strongest companies in the US economy without you having to fiddle or keep up with the latest news and headlines. You know, your money is in America as a whole. Your money is in the world as a whole. You know, I plan to make a video in the future on why international investing is a bit of a, not a scam, but why international investing isn't necessary and how by investing in the US you invest in the world. And that's my opinion personally. Again, I'm going to make a video on it, but what I want you to know is the US leads the stock market. When the US moves up, the world moves up. When the US falls, the world falls. So by investing in the strongest companies in the US economy, you are investing in the stock market as a whole. You invest into simplicity, diversification, and emotional protection. And again, our goal is to hit 1 million in 20 years. So let's bring this back to the numbers, the figures. What is required of you every month to hit this financial milestone? So step 2, historical average returns. Let me be clear again, I'm not a financial advisor. past returns do not always guarantee future results. We have been through a weird couple of years in the stock market, a lot of micro crashes, flashes, etc. But that doesn't mean that we're living in the end times. Don't let short-term fluctuations and volatility scare you away from putting your money into the market. Time in the market beats trying to time the market. Time you spend in the market beats trying to time when you get into the market. Don't wait for the perfect time. Don't fall for fear mongering. Or don't wait for a giant crash to start investing. We're building over a long time horizon here. We're building over decades. Your money is going to have years, 15, 20, 30, 40 years to compound. And in that time, any short-term market fluctuations will be completely leveled out. So trying to time dips is very short-sighted. It's very pointless, especially when we aim to be investing over literal decades here. I know people that had seen the crash in April last year. They'd seen the tariff scare and they've waited. They haven't been putting any money into the markets because they think a crash is coming. People who harp on about how the AI bubble is going to burst and how we're going to see a crash soon, they're the ones losing out. Right, so let's get into the numbers. So the historical averages. So the average annual return rate for the S&P 500 is between 8 to 10% over longer time horizons. And adjusted for inflation, the net is close to 7 to 8% average return year on year. And returns aren't always consistent. In 2022, the S&P averaged an 18% loss, but in 2023, made a 26% return. But what the data tells us is that you can expect an average 7 to 10% nominal return year on year. And in my opinion, it's always best to plan for the worst. Plan for a 6% gain or a 7% gain year on year, and then perhaps look at the 8% averages, and then maybe look at the 9 to 10%, but don't bank on that being your future, because it is the best case scenario, it is the ideal situation. But I want you to look at the worst case scenario and be prepared for the worst. Understand that we are not predicting the future here. We are making conservative estimates using historical data for the S&P 500's average returns. And we're going to do our calculations in a second, but I briefly want to detail just one more key concept that you need to understand to invest intelligently, and so you get the most value possible out of your money every month. The way to further combat volatility and uncertainty is to dollar cost average, or to DCA, which involves investing a fixed amount every month, week, or at a regular set interval, no matter what the market is doing or how confident you are feeling. So inevitably, when prices are high, your money buys you less. When prices are low, your money buys you more. But over time, your entry price averages out and emotion is removed from the process entirely. You stop trying to time crashes and dips and you just stay consistent. And over 20 years, consistency beats perfect timing every time. Every major crash in history has eventually recovered and then gone on to reach new highs. Volatility does not hurt long-term investors. And when you combine DCAing with diversified ETFs and time, you're no longer gambling, you're compounding. You are building an abundant future on a stable foundation. Now let's bring this back to the numbers, the calculations. What does it actually take to hit 1 million in 20 years? So 3, the calculations, the estimated forecast. So to hit 1 million invested in 20 to 30 years at a 7% conservative growth rate, you would need to invest between 1,500 to 2,000 every month. And again, this is the forecast at a conservative growth rate. 7% is very conservative. Again, the S&P 500 averages 8 to 10% year on year, but we're looking at the low end of that. I'm not selling you a fantasy. I'm not being out of touch. I want you to understand that with consistency and discipline, that this goal is very achievable. If you forecast with a 10% growth over 23 years, you can hit 1 million with only 1,000 per month. But again, I always prepare for the worst, and I want that for you too. Some years may not perform as well. So aim higher, aim to invest more every month. Invest 1,500 per month. And if the next decade or two performs well, you hit 1 million early. If not, then you hit your goal on time. It's better to be conservative and surprise yourself to hit your goal early than to overestimate and hit your goals later than you thought you would. So the point is, if you invest between 1,000 to 2,000 a month, you can hit 1 million in 20 to 23 years. And if you can find ways to increase your active income and you can invest £3,000 a month, then you can hit 1 million in 15 years. Of course, the time in which you achieve 1 million invested depends on how much you earn and how much you can then invest. And if you're like me, if you're young, you're 18, 19, 20, perhaps you're in your early 20s, you're going to be investing for decades, 30, 40, maybe even 50 years. If you can get to the stage where you've been investing regularly, minimum $1,000 a month over a few decades, you can get to the stage where the snowball effect really kicks in and your money starts to seriously compound. And this is how you can hit those multiple 7 figures. If you continue to invest over your lifetime and you continue to increase how much you invest, then the possibilities are really endless. There's an option on the compound growth calculator to account for increasing your monthly investment over the years, so do account for that too. And if you want extra credit, if you're really looking to become wealthy over time, you aim to hit your first $1 million and you continue to invest incrementally higher amounts of money. And you do this by increasing your active income, by developing your skill set, by working on your business, or becoming better at your job. But yeah, have a play around with this calculator. I'll leave it in the link in the description. There are a few more key points that I need to explain before you're ready to invest. So step 4, setting up your account. Now, this is one of the easiest steps of this guide. So you've heard my estimated forecast, you now estimate your own forecast, and you have a rough idea of what is required of you, how much you need to invest to hit your financial goals. Whether that's 100k or $1 million or 2 million, don't stop now. No more waiting. You got to stop putting this off and just start. So open your account. Remember what I said earlier, time in the market beats timing the market. Put your money to work as soon as you can. And don't be scared by all the brokerage accounts, fancy names and platforms. Do a brief bit of research into what is available for the country that you're in and don't overthink it too much. If you're in the UK like myself, I would highly recommend using Vanguard or Trading 212. You need to verify your identity, link your bank account, and that's about it. Do not be intimidated. It's not a long or tedious process. You can get this set up all within an hour. And again, the forecast that we used earlier is based on the S&P 500's historical averages. So find out what ETF or mutual fund tracks the S&P 500 in your country and pick whatever company works for you. If you're in the US, you could use Vanguard, State Street, or BlackRock, VOO, SPY, IVV. If you're in the UK or Europe, you can use Vanguard's VUSA or VUAG. I know a lot of people use Trading 212 to invest into ETFs. Different countries, slightly different names in ETFs, but point is you want to track the S&P 500. You want to track the top 500 American companies. So choose a simple, reputable company. Don't overthink it too much. Just make sure the company offers the S&P 500 in your country and fits your needs. And make sure to take advantage of tax-free or tax advantaged accounts. For example, if you're in the UK, set up your account as a stocks and shares ISA. If you're in America, look at 401ks, Roth IRAs, etc. But once your account is open, you set up either automatic monthly contributions or you manually invest as soon as you get your paycheck, and you let your money work in the background. You stay consistent and you stay disciplined. Again, have a play around with the compound growth calculator, understand what's possible, adjust the monthly amounts, experiment with different growth rates, look over 10 years, 20, 30, even 40-year time horizons. What you'll notice is that progress at the start is slow, your balance is small, and your yearly gains are there, you're building, but it's slow but steady. But as you look closer and you see the years go by, the number gets higher and higher. The snowball starts to take over until eventually the growth from compounding begins to outpace the money you're adding in yourself. And at that point, your money is working harder than you are. Look at year 30 and year 40. See for yourself how much money your money makes for you. Don't think I'm lying to you right now. Use the compound growth calculator and see what's really possible for yourself. Don't just take my word for it. You could get to the stage by year 20, 30, 40 where you stop investing your £1,000 a month and your portfolio would still continue to grow at a crazy rate. And this is the moment where people finally understand the magic of compounding. Not intellectually, not numerically, but emotionally. When you see the figures, you understand damn, this is what they were talking about. Because you realize you're no longer building wealth with effort. You're building your wealth with momentum. And this right here is the freedom that you want. This is the freedom that we all should be aiming for. By that point, you could set off X amount every year. This is called your SWR, your safe percentage withdrawal rate. How much you can pull out of your portfolio every year to live. And I'm not going to go into too much detail because this is very end game and you don't need to worry about the numbers too much. But if your portfolio is worth 10 million and you pull out 2, 3, maybe 4% a year, the S&P is yielding you 7%. So your portfolio is still growing by 3, 4, 5%, and you can take out 200 to 400k every year to use as spending money. And if you want to know what the really wealthy do, what the real end game of investing is, having so much invested, having multiple, if not tens of millions invested, and being able to get a loan off off your portfolio. You get a loan using your assets as collateral. This is called asset-based lending. This is what billionaires, multi-billionaires do. You know, this is why the billionaires are notoriously hard to tax, because they don't keep anything to their name. They get loans, they leverage debt, and they don't pay themselves a real salary. Instead, they build an asset, they build their investment portfolio or their company, and they get a loan using their assets as collateral. So for example, someone like Elon Musk owns multiple companies valued at, let's say, 200 billion. He can borrow 5-10 billion, even more, against that 200 billion value without selling a single share of ownership. He keeps the asset, he keeps the upside. And in your case, one day your portfolio may be worth 2 million, and so you decide to borrow 200k against it. You now have access to that money without selling the asset. And again, you don't get taxed on loans. And what's even more mind-blowing is that over time, inflation works in your favor. The money that you've borrowed becomes worth less in value. So not only is inflation eating at the true value of how much you have to pay back, but your assets continue to grow and your wealth keeps compounding while you live off that liquidity. And this is the real end game, not just having the money, but having assets so powerful that money becomes almost optional. And what you're doing now is laying the foundation for everything that the future has in store for you. You know, the money you're investing, the hours of work that you're putting in, the early mornings, the late nights, the time committed to your education, to learning new skills, you know, to becoming financially literate, the discipline, focus, resilience, and willingness to learn is leading you to this result in 20-30 years. And I'm not being unrealistic here. Whether your goal is 100, 500k, a million, 5 million, 10 million and beyond, with consistent effort, financial discipline, and consistent learning, those goals are achievable. And I understand that these numbers can feel intimidating. And I know you weren't taught to think like this in school. You weren't shown how money actually works. You weren't taught about compounding and assets, how to build long-term systems. You know, most of us were taught how to survive, not to build, to earn, not to invest, to follow paths, not to design our own. So I want this video to inspire you. Don't let it overwhelm you. This channel exists to teach a new way of thinking, to help you shift your belief system, to fortify your mindset, to stay disciplined, focused, and intentional with your life. Because the moment you start learning, start applying, that's the moment you take ownership of your future. You know, you don't need to be perfect, just need to be consistent, and that's why this will work for you. So if you found this useful, take it seriously. You know, if you want more content like this, practical, no hype breakdowns on money, discipline, and long-term thinking, consider subscribing. I'm documenting what works, what doesn't, and how to build real financial stability over time. And remember, the goal isn't to get lucky, it's to build a system that makes success inevitable, because clarity beats motivation every time.